Welcome to This Explainer. Okay, are you ready to decode the invisible game of finance? Most of us just go through life thinking money is this super boring math problem. But honestly, it's really a hidden game. It's a game with a very specific set of rules. And the absolute best part is that once you learn these rules, you can absolutely beat the system. So, let's get into it.
To even start playing, we have to ask a wild, kind of mind-bending foundational question. What if the money in your pocket isn't actually real? Seriously, think about it for a second. Currency is fundamentally a social construct. It's built entirely on shared belief and trust. Sure, the government prints it and central banks regulate it to make sure we don't end up with, worthless monopoly money. We all trade it every day. But at its core, it literally only works because we all collectively agree to believe it works.
All right, level 1, the construct and the toll.
To really break down that illusion of value, consider this. On one side, you have a dollar bill. On the other, a stick from your backyard. There is absolutely no biological or physical law in the universe that makes the paper inherently better than the wood, right? The only reason a dollar bill can buy you a coffee and a stick can't is that society has collectively agreed that the dollar has worth. We all essentially signed the exact same invisible contract.
But living in this society where our money has an agreed-upon value, well, it comes with a massive subscription fee. Taxes. This is just the cost of civilization. It's how the government builds roads, funds our schools, and ensures your absolute favorite street taco truck is totally rat-free. Yet the whole process of actually filing them is this bizarre guessing game. The government knows exactly what you owe, but they make you guess. And if you guess right, hey, you're fine. But if you guess wrong, you're cooked.
So, this is exactly how your money leaks out before you even get to see it. Imagine you get a $2,000 paycheck from a really long, hard month of work, but you log in and your bank account only shows $1,456. Where did the rest of the whole shebang go? Well, it gets sliced up. Income tax hits the money you make, sales tax hits the money you spend, and capital gains tax hits your investment profits. Then, of course, there's Social Security, which is basically the government forcing you to save up for your own retirement, and Medicare, which goes to supporting older folks or those with serious health issues.
Moving on to level 2, the middlemen and the leaks.
When you deposit $1,000 into the bank, most of us picture it just sitting there in a giant, impenetrable vault, maybe being guarded by a dragon. But the reality? That money is already gone. Banks operate on something called fractional reserve banking. They are really just middlemen, matchmakers, if you will. When you deposit your cash, the bank keeps a tiny fraction on hand and takes the rest, say $900 of it, and immediately lends it out to some guy who wants to buy a jet ski. They entirely rely on the idea that not everyone is going to show up on the exact same day asking for 100% of their money back.
Now, if everyone actually does show up all at once, the whole system just crumbles, which is actually exactly what happened back in 2008. But hey, don't panic. To keep that crucial trust and belief in the system alive, the U.S. government stepped in with a safety net. Individual bank deposits are insured up to $250,000. So, no matter what happens to that guy and his jet ski, the government assures you that your deposits up to $250,000 are perfectly safe.
So why do banks even bother doing this matchmaking? For the silent engine of the entire financial world, interest. Imagine borrowing $1,000, but eventually having to pay back $1,280. That extra $280? That's the interest. And there are two main types here. Simple interest is kind of like a flat fee, a little thanks for playing charge. But compound interest? Oh, that's when every single dollar you borrow makes clones of itself, and then those clones also start charging you rent.
It really just boils down to this. Interest is money's way of charging rent. If you owe a 20% interest rate on a credit card and you miss a payment, that interest starts earning its own interest. Suddenly, that $12 burrito turns into a $50 regret. But if we flip the script, if you are the one earning a 7% annual compound interest on an investment, that is your money duplicating itself. It acts as a literal cheat code for building wealth.
Let's look at the silent wealth thieves.
Here's how inflation actually works out there in the real world. Imagine a business has 1,000 TVs, and they're priced at $500. But there are 2,000 buyers flush with cash who all want them. What happens next? The business realizes the demand is sky high and simply raises the price to $800. That is inflation. When too much money chases limited goods, the actual value of your currency drops. So suddenly, your $5 bill just doesn't buy as many instant noodles or as much gas as it did yesterday. When inflation spikes like that, the government tries to cool things off by raising interest rates, which unfortunately can sometimes trigger the other wealth thief, a recession. A recession is officially recognized after 2 consecutive quarters of economic decline. Think of the economy like a massive, raging party. You have the boom phase, everyone's out there dancing, then the peak. But eventually, the lights flicker, reality hits, and we enter the bust. Jobs vanish, people stop spending. It's really painful, but ultimately, it's a reset. Eventually, spending returns and the whole cycle just starts all over again.
Level 3, your financial trust score.
So, your credit score isn't actually a measure of your overall wealth at all. It's purely a measure of trust. Lenders are really just asking one single question. If I give this person money, will they actually pay me back? The algorithm looks at your credit utilization, the age of your accounts, the mix of loans you have, and your new credit applications. But the absolutely crucial point is that first one, payment history. Making your required payments before entering the late period is literally the most important action you can take.
So where do you stand? The score ranges from 300 up to 850. If you fall below 580, to a lender, you are essentially a walking red flag. You're going to get hit with massive interest rates, assuming you even get approved for anything at all. But climbing over that 750 mark, that grants you sparkling adult credibility. It opens the doors to the absolute best possible rates on houses and cars.
Honestly, think of your credit score kind of like a pet dog. You ignore it, and it totally ruins your life. But you take care of it, and it buys you a house. This really highlights the weirdest reality of the whole game. You can have absolutely zero debt, live completely responsibly on cash, and still have a trash credit score simply because you haven't played the game. Lenders want a history. They need proof you can handle the dog.
And finally, level 4, the cheat codes.
Consider this comparison for a second. An average rock versus shiny yellow gold. Gold isn't really inherently more useful than an average rock in our daily lives, right? But it is rarer, and human beings collectively place a much higher value on it. Wealth is generated through perceived value. If you create value, or frankly, even just perceived value, people will give you their money. It's the exact same reason a standard handbag at Target costs $30, but a designer handbag with the exact same function can be priced 100 times higher. Society just perceives it as more valuable.
Once you actually capture some of that value as income, you need to use the ultimate cheat code, investing. And you have great options here. Stocks give you tiny little ownership slices of real companies. Bonds are basically loans you make to a government or a company, and they pay you back with interest. Funds are just collections of these assets to keep things super simple. And real estate is, of course, physical property. Wealthy people, they don't rely on luck with these. They just buy them and give compound growth 30 years to do its magic.
Because the real danger isn't losing money, it's never investing and watching inflation quietly steal your future value. Yes, markets go up, they go down, investing absolutely comes with risk. But letting your cash sit completely idle under a mattress while inflation marches on, that is literally the only guaranteed way to lose the game.
It all comes down to how you view your single most valuable asset, time. The trap that most people fall into is trading 1 hour directly for one paycheck, direct wage labor. But the leverage strategy of top earners looks entirely different. They train their hours to work for them. They build skills, they start businesses, and most importantly, they invest, allowing time to multiply their wealth over decades.
Wealth isn't built in days, it is built in decades. So as we wrap up this explainer, I really want to leave you with one final provocative question to think about. Are you going to keep letting the system play you, or will you use time to train your money to work for you? The rules of the invisible game are right in front of you now. It's entirely up to you how you play your next move.